there's been a lot of sector rotation. I mean, I think these sectors have more jukes and moves than a Colts quarterback or a running back. You know, it's the leaders are kind of at the bottom and vice versa. But to kind of give you an idea of where we are right now, real estate is number one. Now, the way we measure this is volatility weighted relative strength. And what that means is that the strongest companies a lot of times will get to the top of the list because stocks tend to trend, but sometimes they get kind of parabolic. They get too far ahead and then they take a big hit. What we do is we rank these based on their volatility. So if one security has twice the volatility of another, it has performed twice as strong. So it puts all of these on an equal playing field. Cash could be number one, theoretically. So real estate was number one. At the beginning of the year, it was number 9. That's out of 11. Energy is number 2. It was number 8. I'm just going to do a few of these. Financials was number 4, and it was number 2. So I didn't really move that much. But let's go to some of the ones that moved up. I'm sorry, financials was number 3. Now it's number 7. So that's fallen off. That's just over the last few weeks. Industrials, number 1. Now they're number 8. Discretionary, number 2, and that's mainly Amazon, is now number 9. Kind of gives you an idea of the rotation. Material, number 4, now they're 10. The one consistent one is utilities. It was number 11, and it's still number 11. So, so that may tell you something about interest rates there. Bonds had a really bad year last year, and now actually, and it's continued through this year, but they've kind of picked up over the last couple of weeks. Commodities have a good run. Now gold is one of the weaker commodities, where it was stronger. The dollar was weak. Now it's picked up some steam, has moved up through the list. And I think it's the number 2 currency right now, was like close to the bottom. So a lot of change.
How about technology, Tom? Where was it? Wasn't it last year all about technology?
It's been all about technology for about the last 6 or 7 years. And that's what makes the market kind of look like 2000. You know, if you go back to 1993, technology made up about 6 or 7% of the S&P 500. And the S&P was pretty well balanced among the sectors because the S&P is a cap weighted index. The bigger the group gets, the more impact it has. By the time we got to 2000, technology was 43% of the market. Right now, technology is about 40 to 42% of the market. And I think over the last 7 years, technology has gone up, say, 700 to 800%. Back in 2000, over 7 8 years, it went up about 700 800 900%. Most of that coming in the last 2 or 3 years, which again is very similar to now. So again, that's why it's kind of hard to beat the index, because no portfolio manager, you know, is interested in risk management, is going to put 40% plus of their portfolio in tech related stocks.